Welcome to today's deep dive. If you are joining us, you know the drill. We are skipping the surface level noise and getting straight into the structural shifts happening right underneath the headlines.
Exactly, getting right into the real story.
Right. And we have a massive stack of sources on the table today. We got data from the Bureau of Labor Statistics, China's National Bureau of Statistics, plus real-time public filings and on-the-ground reporting from Reuters, Bloomberg, and the Wall Street Journal.
It is a heavy stack this week.
It really is. And our mission today is to map out a phenomenon we are calling the divergence. Because, well, if you think about the baseline assumption we've all been operating under for decades, it's that the global economy is a relatively synchronized machine.
Right, it assumes convergence.
Exactly. When the economy slows down, inflation falls, credit tightens up uniformly across the board, and central banks have a clear, singular direction to take. But right now, the data is completely breaking that model.
It's breaking the model in real time, and it's doing it everywhere you look. I've been poring over these numbers all week, and the pattern recognition alarms are just absolutely going off.
Yeah, I bet.
We are going to connect the dots across 3 different continents today. And what becomes incredibly apparent when you aggregate this data is that the global economy is no longer moving as one unified system.
It's fragmenting.
Yes, we are watching it split into parallel, deeply contradictory realities.
I have to admit, when I first looked at the files for this week, my initial thought was to just write it off. I mean, isn't some of this just normal market noise?
It's easy to think that at first glance.
Right, because economies have weird months, supply chains have hiccups, data gets revised all the time. But as you start stacking these contradictions on top of each other, that skepticism fades pretty quickly.
It really does.
Okay, let's unpack this. We are starting in China.
The first major contradiction.
Right, the world's second largest economy just posted its highest inflation in 37 months. Their CPI rose 1.3% year on year in February.
Which totally smashed the 0.8% expectation.
Smashed it. Month over month, prices rose 1.0%. Core CPI hit 1.8%, which is the strongest we've seen since March 2019.
But then you look at the factory side.
Exactly. At the exact same time, factory PPI fell 0.9%. We're looking at a system where consumer prices are surging, but the factories producing the goods are actively deflating.
Which is structurally fascinating. Those two numbers just shouldn't coexist in a healthy ecosystem.
They really shouldn't.
Factories are selling their goods for less, slashing their own margins, while consumers are somehow paying more at the register. It's literally 2 distinct economies operating inside one country.
But let me push back on this for a second, because China's government work report just set their CPI target at around 2%.
A number they haven't consistently hit in years, by the way.
Right. So if consumer prices are finally moving up toward that 1.8% mark on the core side, couldn't you argue this is just a sign that their massive economic stimulus packages are finally taking hold? Isn't this exactly what recovery looks like on paper?
That is the comfortable consensus view.
Yeah.
You look at the headline and think, oh, the stimulus is working. But if you look under the hood, the structural reality is actually quite grim.
How so?
This isn't a broad, sustainable economic recovery. What we are looking at is a holiday sugar rush trapped inside a much larger, much heavier cycle of structural deflation.
A holiday sugar rush.
Yes. That jump in core CPI from 0.8 to 1.8% in a single month was driven almost entirely by Lunar New Year spending. It is a localized, calendar-based spike.
So people traveled, spent money during the holiday, and service prices briefly spiked.
Exactly. But the fact that the PPI is still deeply negative at minus 0.9% tells you that the manufacturing engine, the actual core of their economic model, is still deflating.
Wow.
Factories are slashing prices just to compete. They're completely drowning in overcapacity.
And the evidence for that structural drag is glaring when you cross-reference this with the real estate data in these reports.
Oh, the property sector is a huge weight on this.
The hangover is acting like an anchor on everything else. Residential land transactions in 300 major cities plummeted by 30% in just the first 2 months of 2026.
30%? That is a massive drop.
Massive. The government has had to roll out a drastic new strategy internally called, quote, control new supply, reduce inventory.
They're trying to stop the bleeding.
Right. They're using city-specific policies to literally convert surplus commercial housing into subsidized housing. Developers aren't buying land because they are choking on the inventory they already have.
And that real estate dynamic is the absolute key to understanding the consumer side here. In China, property is the primary vehicle for household wealth.
So when property values stagnate or fall,
Household wealth shrinks, and consumer confidence collapses right along with it.
makes sense.
So underlying domestic demand stays incredibly fragile. You might get a brief one-month spike from a holiday, but the broader trend is defensive saving.
If we connect this to the bigger picture, this isn't just a domestic issue for China, is it?
Not at all. Because those factories are cutting prices to survive and clear out their massive overcapacity, they are essentially exporting deflation to the rest of the world.
They are flooding global markets with cheap goods just to keep the lights on.
Exactly. Which directly impacts everyone's wallet. If you are buying electronics, auto parts, or capital goods right now, that factory deflation in China has been acting as a massive deflationary cushion for the broader global economy.
It's been keeping core goods prices lower than they otherwise would be for all of us.
Right. But here is the critical vulnerability in that setup. What happens when that Lunar New Year effect fades, and those Chinese factories are forced to either cut prices so deeply that they start going bankrupt?
Or the government steps in.
Exactly. Or the government forces industry consolidation and prices suddenly stabilize. That deflationary cushion disappears. And it might disappear right at the exact moment that global oil prices are pushing headline inflation higher.
So consumers are going to feel two entirely opposing economic forces colliding at the checkout counter.
Precisely. The era of cheap imported goods offsetting domestic service inflation is coming to an end.
Here's where it gets really interesting. Because if Chinese factories are exporting a deflationary cushion, you would expect Western markets to feel some relief, or at least some stability.
I think so.
But when you look at U.S. credit markets, relief is the absolute last thing you see. This brings us to our second major divergence. And the numbers here are just wild.
The credit clash.
Yeah. Last week, BlackRock gated a massive $26 billion private credit fund called HLEND. They just locked the doors.
Investors wanted to pull their money out.
And the fund effectively said, no, your capital is staying put. That happened on a Friday. But by Wednesday of that exact same week, Wall Street had pushed through over $73 billion in new bond issuance.
The public credit market was absolutely on fire.
It's a staggering juxtaposition.
It really is. You have one of the premier private credit funds freezing up, signaling severe illiquidity and stress, while simultaneously the corporate bond market is having one of its most explosive weeks of the year.
One pipe is completely frozen, and the other is just bursting with capital.
Exactly.
I saw the headline about the $73 billion in bonds, but who is actually absorbing all that debt in the middle of a global conflict?
That is the million-dollar question.
When you dig into the specific deals, you realize these aren't just routine refinancings. JP Morgan just led a $55 billion leveraged buyout of Electronic Arts.
The largest LBO in history.
And the debt package for that single deal included about $20 billion in non-investment grade bonds and loans.
And look at who bought into that debt. Silver Lake, Saudi Arabia's public investment fund, and Affinity Partners.
That is the largest speculative grade commitment ever underwritten by a single institution.
But that EA deal is just one piece of the puzzle.
Right. You also had Baker Hughes raising $10 billion in a cross-border bond sale to buy Chart Industries. They're expanding heavily into LNG and data centers.
Huge move.
And Eaton Corp raised $8.5 billion in investment-grade bonds, specifically to fund their $9.5 billion acquisition of Boyd Thermal.
Which specializes in liquid cooling for AI data centers.
Exactly. Just those three deals, EA, Baker Hughes, and Eaton, account for $38.5 billion in new corporate bonds in a single week.
So how do we reconcile this? The consensus narrative looks at that $73 billion and declares, wow, the credit market is incredibly robust.
Right. They see the big number and assume everything is great.
But that is a complete misreading of the map. What we are actually seeing is the manifestation of the divergence. The top of the market and the middle of the market are living in two totally different realities.
So that $73 billion isn't a sign of broad, systemic economic confidence.
Not at all. It's a sign of aggressive consolidation.
But wait, couldn't you argue that this is just panic borrowing?
How do you mean?
Well, if these massive corporations think the Fed is going to be forced to hold rates higher for longer because of inflation, wouldn't they just rush to issue debt now to lock in capital before borrowing costs get even worse? Why are we assuming this is consolidation and not just a desperate dash for cash?
It's a fair question, but you have to look at the use of proceeds. They aren't hoarding cash on their balance sheets to weather a storm.
They're spending it.
They are deploying it immediately into massive landscape-altering acquisitions. Eaton isn't raising $8.5 billion to keep the lights on. They are buying Boyd Thermal because the physical infrastructure required for AI data centers is literally melting.
Wow. So they are buying the solution.
They know liquid cooling is a bottleneck for the entire artificial intelligence sector, so they are using their pristine credit rating to buy the bottleneck. They are building an impenetrable moat.
And the same goes for Baker Hughes, locking up LNG and industrial tech.
Exactly. When macroeconomic stress hits the system, it doesn't hit everyone equally. The largest, most creditworthy giants actually get more access to capital because institutional investors, terrified of risk, flee toward the safest-looking names.
It's like being at a casino where the VIPs are getting free drinks and unlimited chips, but the bouncer just chained the doors to the parking lot for everybody else.
That is the perfect analogy.
The headline, bond market is serving the giants. But that private credit market, the one where BlackRock just gated their $26 billion fund, that market serves the middle layer.
The mid-market.
Right. It serves your local commercial real estate developer, the mid-sized logistics company, maybe even your employer or your suppliers.
That is the exact fracture point. The drawbridge is pulling up for anyone who isn't a mega-cap corporation.
The top of the market is wide open, but everyone else is locked out.
The companies that depend on private credit because they don't have the scale to tap the public bond markets just saw their lenders hit the brakes.
Yeah.
If you operate or work for a mid-sized business, this divergence in who can borrow money and who can't is going to dictate your operational reality for the next 3 years. The giants are expanding, and the middle layer is being completely starved of oxygen.
Which perfectly sets up how a central bank is supposed to manage this mess.
Yeah.
Let's pivot to the United States and the upcoming Bureau of Labor Statistics CPI report.
This is where the tension really builds.
Let's lay out the baseline expectations. For the February CPI data, the forecast is for headline inflation to be up 0.3% month over month and up 2.4% year over year.
Right.
For core CPI, expectations are sitting at up 0.2% month over month. The Cleveland Fed's inflation nowcast is pointing to a very similar range, around 0.22% for core. In a normal month, a 2.4% year-over-year print would be celebrated.
What's fascinating here is that the number itself is already obsolete.
Completely irrelevant before it even hits the wire.
Exactly. The algorithmic trading bots and the consensus analysts are going to look at that 2.4% and say inflation is tamed.
Mission accomplished.
But that completely ignores the timeline of the data collection. The February CPI is the last clean number we are going to get.
Because of the conflict.
Right. It was collected before the Iran conflict caused a massive structural shock to global oil markets. It was measured before crude crossed that psychological and economic threshold of $100 a barrel.
So starting with the March data, which won't be reported until April 10th, every single CPI print is going to carry a heavy war premium.
Tomorrow's number is just a snapshot of a world that no longer exists.
And the mechanics of that war premium are brutal because energy bleeds into everything. It's not just the price at the pump. It's the cost of aviation fuel, maritime shipping, petroleum-based fertilizers, and the raw manufacturing inputs we were just talking about in China.
It cascades through the entire system.
But this delayed data is landing in the worst possible context for the Federal Reserve. They are meeting in just 8 days. Their benchmark rate is currently sitting at 3.25 to 3.50%.
And markets are expecting them to hold steady, right?
They are. But traders are weirdly pricing in rate cuts starting in June. Yet the Fed is staring down a truly horrific jobs report. We just saw a net loss of 92,000 jobs in February.
92,000, that's a huge contraction.
Unemployment ticked up to 4.4%. And maybe most concerning, the labor force participation rate dropped to 62.0%.
Which is a 4-year low.
Yes. Plus, December's numbers were revised down into negative territory. 3 of the last 5 months have been negative for job growth.
And there is the ultimate divergence. The Fed operates on a dual mandate, maximum employment and price stability.
Right.
Right now, the employment side of their mandate is actively fracturing. The labor market isn't just cooling, it's contracting.
Losing almost 100,000 jobs a month is definitely contracting.
But the price stability side of their mandate is about to catch fire because that supply-side oil shock is incoming.
So what does this all mean?
We are looking at a textbook, unadulterated setup for stagflation, an economy that stagnates and sheds jobs while essential prices continue to rise.
It feels like we are watching a slow-motion replay of the 1970s. How do they even navigate this?
Yeah.
If they use their primary tool interest rates, they're damned either way.
The 1970s comparison is incredibly apt here. Back in the Arthur Burns era of the Fed, they faced a very similar supply-side oil shock.
The Arab oil embargo.
Exactly. They tried to thread the needle, they waited too long to pick a side, constantly oscillating between trying to save jobs and trying to fight inflation.
And it didn't work.
No, the result was a lost decade of economic pain until Paul Volcker finally came in and had to push interest rates to agonizing levels to break the psychological back of inflation.
So do you think today's Fed is looking at that history?
The internal debate suggests they are keenly aware of it, but they are completely divided on how to apply it. You have Fed Governor Christopher Waller going on record calling the current oil price increase a temporary event that shouldn't dictate monetary policy.
He's leaning toward protecting the labor market.
Yes. But then you have Boston Fed President Collins taking the absolute opposite stance. She stated she sees no immediate need to lower rates and wants durable evidence that inflation is actually moving toward the 2% target, regardless of the oil shock.
It is a paralyzing dilemma. If they prioritize cutting rates to support this bleeding job market, they risk pouring gasoline on the oil-driven inflation shock, essentially telling the markets that they will tolerate 4 or 5% inflation.
Right.
But if they hold rates high to fight the supply-side shock, they are actively punishing a labor market that is already losing 90,000 jobs a month.
Yeah.
And this hits your wallet directly.
It absolutely does.
Your mortgage rate, your auto loan, the yield you get on your savings account, all of it hangs in the balance of this internal debate.
It does. And understanding this baseline gap, the difference between the clean pre-war February data and the shock March data, is how you actually prepare for what happens when the Fed is forced to make that impossible choice.
Because the market is pricing in a return to normal, but the underlying data is screaming that normal has left the building.
When you lay all these pieces out on the table, the picture it paints is remarkable. We are looking at three massive structural divergences that completely shatter the old economic models.
The old model of convergence is just broken.
We truly are looking at an economy of parallel fragmented realities. You have China, where localized holiday consumers are spending while the massive manufacturing sector continues to deflate. Two economies operating inside one country.
Yep.
You have Wall Street issuing record-breaking billions in bonds to the absolute biggest corporate giants they can build impenetrable moats, while private credit funds serving mid-sized companies are slamming the gates shut. Two completely different credit markets serving two different tiers of reality.
And you have the U.S. Federal Reserve relying on an inflation number that is already obsolete, paralyzed between an employment contraction and a massive geopolitical inflation shock.
It really forces you to read the news differently.
It really does. And that brings us to our final thought for today. If the global economy is no longer a single unified machine, but a series of fragmented, contradictory realities, what does that mean for you?
That is the big question.
Think about your own industry or daily life. Which reality are you operating in right now? And what happens when the reality of the giant corporations completely detaches from the reality of the mid-sized businesses around you?
If the Fed's hammer can no longer fix a fragmented machine, it's going to rewrite the rules for every asset class on Earth.
Something to definitely keep in the back of your mind as you watch the data roll in next week. Thank you for taking this deep dive with us today. Keep questioning those headlines, keep looking for the divergences under the surface, and we will see you on the next deep dive.